3 at 3 for the 9th of February, and we are just getting started. We got a lot of ground to cover, so let's get to it, shall we? Bang, bang, bang. The disclaimer says that this is for educational and informational purposes only. Full stop. Before you go out there and say, oh, John told me to do this or told me to do that. No, I didn't. I am following unusual activity. I am citing it for you here. If you choose to act on it, that's of your own volition. I would counsel you that you need to speak to an investment professional before you make an investment. And, of course, an informed investor is a better investor. So please make sure you understand the strategies that I'm about to describe before you just willy-nilly go out and throw money at something. No offense to the Wall Street Bets crowd. I think they did spectacularly well on the way up in GameStop, in AMC networks, in COS, headphones, and the like. But I think there are always ways you could lock in more money of the money that you've captured and still remain long. Nonetheless, all investments involve risk. Let's just leave it at that, shall we? This presentation is by me and Market Rebellion. So before you reproduce it in any way, shape, or form, please ask us, because we have registered marks, we have trademarks, we have patents, we have copyrights on virtually everything you're about to see. So before you go and just use this, please ask us and then cite Market Rebellion. Thank you. All right, let's take a look. Let's see. This was a trade, several trades, in fact, going back to January 5th, as you see, and I could show you back further, but then it would crowd the page even more. But this is Veru, V-E-R-U. Talked about it last week for unusual activity. I made it my final trade, I believe, on either Thursday or Friday. I think it was Thursday. Anyway, Veru, as you see, we started at least where this begins in, what was that, the 5th of January, and they were buying the February 10 calls. Then, and the stock was $8.39. Then the stock jumped to $10.93 a month later, the 4th of February. Not a bad return, 25%. I'll take it. But we don't just trade stock. We trade options too. And those options blew up on that move. So February 1250 calls, they came in and bought 8,200 of those. That's 820,000 shares of stock. And then just 4 days later, the 8th, last Friday, they came in and bought the March 1750 calls. Well, I wonder how Veru has done in that time period. Let's see. Oh, there it is. Bang, there it is. Exactly. So you see that going back to January 11th, this according to Yahoo, and the stock popping some 27% today, just shy of the 52-week high, which it set today, 1780. Bang! That, my friends, is why we trade options, because the options that we're talking about went up many-fold. Stock, yeah, stock moved up and almost doubled from that $8.65 level-ish all the way up here to 1780. But you know what? The options went up 500, 600, 700%. That's why we trade options, because we can take a limited amount of risk and participate in big upside like this. How about this one? Glue Mobile. This video game maker, among other things, has the Kim Kardashian game. And you may have seen the unusual activity that we've been citing since basically it was a $9 stock. And that was the 28th of January, 29th of January, 29th of January again. You see all these different strikes they're buying. They're buying February 8 calls that were in the money, January 29th. You see January 29th, they're buying June 10 calls. You see January 28th, they're buying June 15 calls. So how do you think Glue did, G-L-U-U, when EA steps in and said, buy, buy, buy? That's how they did. Stock popped to $12.64. You see it right there. 33% jump in the stock. Nice move. How'd the options do? Well, the option to buy it at $8, well, that's worth $4.55 intrinsically, as in the money. So that's worked out pretty nicely. Just thought I'd point out a few of these to you. I didn't even get to Teradata. I'll do that someday soon. Anyway, unusual activity. Let's get started. The first of our 3 at 3 is, well, Scott opened it up with Cleveland Cliffs. So CLF, Cleveland Cliffs, stock's down. Why? Doing a secondary, meaning that they were smart enough, the directors and the people inside the company, to say, you know what? Stock has moved up. We should raise some money. So we have something in our coffers rather than just borrowing money. What if we issued some shares? However, when you do issue shares, of course, you dilute the stock, and people get, in some cases, a little nervous. That's, I think, what you're seeing today with that 8% drop. But then they stepped in and bought the April 18 calls. Now, most of you know with the stock basically just at $16, I'm not going to buy the 18 calls. So I thought I'd show you instead what I did do. And that was I bought the at-the-money calls. And as you see here, Cliff's April calls for the 16 strike, the at-the-money strike, we're trading for, the range for the day, I guess, is $1.77 to $2.24. So depending where you bought it, in that range, you are in, and I froze this one on the screen, 216, and selling the 19s against it means that you collect $1.14 against 216. That means you've paid $1.02 for something that could go to $3. Why? Because the differential between the 16 strike and the 19 strike is $3. So you could have a $1 investment go to $3. Since every option is for 100 shares of stock, that $100 investment per option could go to $300. Call that doubling. That's a 200% return on your invested funds, a 3x if you want to look at it the other way. So if you're somebody that trades a 10 lot, this would be a $1,000 investment that could go to $3,000. That, my friends, is how I, using 1-to-1, paying $1.02, is how I move the odds into my favor by basically collecting a premium against premiums that I pay out. So that's the first of our 3 at 3. This is just a gentle reminder again. Thank you so much for so many of you joining our YouTube channel. If you go to YouTube and you type Market Rebellion, you will get this page. And then if you see that green arrow there and you click subscribe, you will be subscribed to our page. It costs you nothing. It's completely free. Just your time. That's what it costs you. But then for that investment of your time, you'll be able to see for free all of Pete's The Take, which he does every day at 10:30 Eastern. You'll see my Compound Interests, which is my podcast. You could see my 60-second videos in the morning, where I give you a setup of what I'm trading in the pre-market. You could get our weekly market report with AJ Monte. You could get my 3 at 3. You get the idea. All of that is part of our YouTube channel. You can get it other places too. We post it up on Facebook and LinkedIn, Twitter, and all the rest. But if you don't want to miss it, make sure you subscribe to our YouTube channel. It is completely free. All right, let's talk about Momo. Because bullish call buying with stock at 17.23. That is Momo. Unusual call buying. They're buying this week expiration. Today's Tuesday. So we have Wednesday, Thursday, Friday, 3 days for this trade to be alive and for something to happen. You know, if you're a regular viewer, that means that I am going to mitigate the time decay, which is theta or T, as much as I possibly can, because that's what can really hurt me in this trade is time decay. Time goes by. These options only have 3 days in their life to be right or wrong. So stock $17.23. They paid 34 cents for these. You know what? They have already doubled. Stock moved up from 1723 to 1770. Those Momo calls moved to 63 cents. They're up 38 cents on the day. Bang! Again, that, my friends, is why we trade options, because we can move the odds into our favor, and a couple different ways you could trade out of this if you so chose. Again, everybody's different. They were buying the 1750 calls. They are 20 cents in the money now. I like laying big calls into them and collecting perhaps 34 cents for selling the 18 calls, which would mean that I could make only 50 cents. Or I sell the 1850 calls. You get the idea. There's a bunch of different trades you could put on to take advantage of what the market is giving you right now. But what the market is giving you is a very short-term trade. It is options that expire in 3 days. Be aware of that, my friends, because I never want to hear from you that I led you into something that, oh, I didn't know it was, only had 3 days. I would have never traded it. I'm banging the table right now telling you, make sure you understand time decay, which is theta, vega, which is V, and that's volatility. All right? By the way, tomorrow, after the market closes, I'm going to be on with Ryan Mastro and Mike Yamamoto, two of the brightest guys on our team. And we're going to be talking about our most popular strategy, unusual option activity. So not just at 3 o'clock, 3 at 3, but tomorrow at 4 p.m. Eastern, we have this webinar. It is completely free. If you go to our website, you can sign up for free and get it live as it's happening. We'll tell you how we find the trades that we find, and you'll get a better understanding that, yeah, we're not creating the wave. We are the guys that paddle quickly and ride the wave. Somebody else has committed that big capital to a trade, and we have followed them in because that's what we do. All right. Thought I'd give you a three-fer here. Three-fer? Three-fer is, let's see, what do these three have in common? Lee, Solo, and Fisker. What do they have in common? Well, they're not even all listed or stocks that are based in the same country, because Lee is Chinese, Solo is Canadian, and Fisker is U.S. So what could they possibly have in common? They're EVs. That's right, EV makers. Now, Solo is a more or less single-person EV, and they do other things too, but Lee is an electric vehicle manufacturer based in China. Solo, an electric vehicle manufacturer based in Canada. And Fisker, an electric vehicle manufacturer. So 3 different electric vehicle or EV plays that hit our heat seeker all at the same time. Bang, bang, bang. Do you think something might be going on with EVs tomorrow or sometime soon? Why do I say that? Well, because they're buying 2 of these 3 were February options. The top one, Lee, was February options that expire this week. And they're just out of the money with the stock at 30.62. They were buying the 31 calls. So also the other one, the Solo, longer term, June 9s. And Fisker, February 1550s, but not February for this week, February for next week. So that's pretty interesting, isn't it? That we would see 3 different EVs all hitting at the same time. There is Lee. It's already moved through the strike, which was 31, you recall. There is Solo, which has also moved to 913. Bang. Highs of the day, 919, so just pennies off of that. And Fisker, $4.3 billion company, moving to 1580. Bang. So what I'm trying to impress on you here is that somebody, probably somebody that runs a portfolio that wants EVs, somebody maybe mimicking Kathy Woods, is in here buying EV stocks right now today. Are they enhancing returns, or are they making big bets that these move up higher fast? Maybe they're doing both. All right, time for questions. You've got questions. I've got answers. Let's get to it, shall we? 3 at 3 _UOA or at Jon Najarian is how you direct those questions to me. Snugging. All right, let's do it. I've got Pop Culture 66, which is POPCULTURE 66, says, Jon Najarian, You highlight snugging up stop orders to protect winning trades. But how do you craft these stop orders to mitigate poor pricing if an option moves significantly to the downside? Thanks for all. Well, if an option that I buy has moved to the downside, I'm more thinking not about snugging up a stop, but about just getting out. You guys know that my limits are that if an option that I'm trading loses 50%, I'm cutting my losses. I'm out. I do that very unemotionally. When you've traded as long as I have, you don't want to sit there watching that loser get bigger and bigger. I just cut it, move on. You don't have to wait till 50%, but that's my risk tolerance for an option, not for stock. So I am unlikely to be snugging up an option to protect an option that's losing. If that option is losing, I'm more likely just to cut it. Thank you, Pop Culture 66. WBA, Walgreens Boots Alliance. Hey, John. This coming to us from @JDR1024. Hey, John. This Uber Walgreens Alliance partnership is genius. Long WBA. God bless you. Like it. I am not long Walgreens yet. Should be perhaps, but I am long Uber. So I agree, Jared. I think this is a great thing, and I love Uber. I also like Lyft. So I think they will continue to be good investments going forward. Thanks, Jared. That's @JDR1024. Robert Nadon, which his handle is @Robert, ROBERT _ Nadon, NADON. Pete Najarian, Jon Najarian. I started reading your book, Follow the Smart Money. Great job, really good. And I do not like to read. I don't blame you. I'm dyslexic. I don't like to read either, but I love books. So I do them all on Amazon. What is that called? Audible. I do them all on Audible, Robert. And I love that because I can be working out, going on the treadmill, whatever, and I'm listening to whatever book I might want to be listening to at the time. I think right now I'm listening to Play Bigger. But anyway, I love that. And I appreciate you reading our book. Thank you very much. Let's see. The question I do have is, where do you see the stock and options orders that go through? Is there a website or something? There is not, Robert. In fact, as I answered on Twitter, we have co-located our computers in the server or in the data centers, so we see these trades as they go tick by tick, every single stock, every single option as they hit the reporting services. In the case of options, that's OPRA, Option Price Reporting Authority. So what we're looking for are blocks of options. And our algorithm, HeatSeeker, finds those blocks, points them out to us, then we dig deeper. And we probably talk about 1 out of 3 or 4 of those. We don't put up every single one. Why is that? Because in many cases, there are mitigating circumstances. I can't really get into all of that right now, but I will in a future podcast. But there are some things. And by the way, Robert, tune in tomorrow. Join us over at marketrebellion.com for that when I've got Ryan Mastro and Mike Yamamoto, and we're going to be talking about how we do what we do. But there is not a website that does what we do. We have proprietary algorithms. We also have patents and trademarks and all that fun stuff. So no, there is not a website that you can see what we see. Speaking of, Inside the Boom, our secret to trading options order flow. So that will be tomorrow, free webinar, February 10th, 4 p.m. Eastern. Make sure you sign up for it. Inside the Boom, our secret to trading options order flow. Check it out, folks. I know you'll love it. We are really grateful for all of you who have committed your time and money to what we do, and I think it's time and money well spent. So thank you. Please join us tomorrow. You can just go to marketrebellion.com, sign up. It is completely free. And if you'd like to learn more about Market Rebellion products, go to marketrebellion.com. If you'd like to learn specifically about unusual option activity, well, by all means, marketrebellion.com /UOA. That is marketrebellion.com FSR.com/UOA. Thank you so much, folks. I hope you have a great day wherever you are, and I look forward to being on Halftime. Let's see, Thursday this week, I'll be back on Halftime, and I'll be sharing insights with all of you who join our webinar tomorrow. Thank you. Hope you have a great day.